Article: How to improve your financial system in your business. If you want your business to grow, you must stop managing money only with emotion. Many entrepreneurs sell, collect money, pay bills, buy products, and at the end of the month they do not know where the profit went. The problem is not always lack of sales. Sometimes the real problem is lack of financial order. A business without a financial system can make money, but it cannot build wealth. That is why the first step to improve your finance is to separate your personal money from your business money. Your business is not your wallet. Your business is an economic machine that needs control, direction, and discipline. Many owners take money every day from the cash register without recording it. They think it's normal because they are the owners, but that habit slowly destroys the financial clarity of the business. You need to assign yourself a fixed salary even if the business is yours. When you have a salary, you stop confusing sales with personal income. The second step is to register every movement of money. Every sale, every expense, every debt payment, every purchase, and every withdrawal must be written down. What you do not measure, you cannot control, and what you do not control eventually controls you. You do not need a complicated system at the beginning. You can start with a simple spreadsheet. The important thing is not the tool, the important thing is the habit. Every day before closing your business, review how much money came in and how much money went out. This simple action gives you power because it gives your information. The third step is to know your fixed expenses. Fixed expenses are the payments that your business must make every month, whether you sell or not. For example, rent, salaries, internet, electricity, accounting, software, loans, and basic service. If you do know your fixed expense, you do not know how much pressure your business has every month. The fourth step is to calculate your break-even point. Your break-even point is the minimum amount your business needs to sell in order not to lose money. For example, if your monthly expenses are 10,000 soles, your business must generate enough gross profit to cover that amount. Many entrepreneurs believe they are making profit just because they sell a lot, but sales are not profit. Sales are only the beginning of the financial story. Profit appears only after you subtract the cost of products, operating expense, tax, debts, and your salary. The fifth step is to review your gross margin. Gross margin tells you how much money remains after paying for the product or service you sold. If your margin is too low, you can sell a lot and still have little money left. That is why you must review your price, your discounts, your suppliers, and your purchasing decisions. A good financial system helps you understand which products are profitable and which products only create movement but not money. The sixth step is to create financial categories. Do not put all the money together without order. Divide into clear areas. You can have categories such as inventory, salaries, rent, marketing, tax, debt payment, emergency fund, owner salary, and profit. Whenever is sold as a purpose, money stops disappearing. The seventh step is to create A weekly financial meeting you with yourself or with your team. In that meeting, review sales, expense, cash flow, debts, accounts receivable, accounts payable, and the goals for the next week. This meeting does not need to be long. 30 minutes can change the direction of your business. The goal is to stop reacting and start deciding with numbers. The eighth step is to build a cash flow system. Cash flow shows you when money comes in and when your money must go out. A business can be profitable on paper but still suffer because it does not have cash available at the right moment. That is why you must plan your payments. Do not wait until the last day to realize that you do not have enough money. Look at the next 7 days, the next 15 days, and the next 30 days. Ask yourself what money will enter, with what payments are coming, and what decision must I make today. The ninth step is to control debt. Debt is not always bad, but debt without strategy can become a silent enemy. Before taking new debt, ask yourself if that money will produce more income or only cover disorder. Debt used to grow a system can be useful. Debt used to hide bad management can be dangerous. The 10th step is to assign money to marketing. Many businesses spend money on rent, products, and salaries, but they forget to invest in attracting new customers. Marketing should not be treated as an emergency expense. It should be part of your monthly financial plan. If you want predictable sales, you need predictable prospect generation. The 11th step is to create financial indicators. Some important indicators are monthly sales, daily sales, average ticket, gross margin, net profit, fixed expenses, debt level, and cash available.